All right. Hey, thanks for joining us, everyone. You are here with Jay Soloff, Will McBride, and Dmitry Pargamanik for today's webinar. Thank you if you're joining us via Investor Alley or Market Chameleon. Jay's a good friend of Market Chameleon and a true chameleon himself. He uses Market Chameleon for finding a lot of unusual option volatility ideas. Tonight's show presentation is Trade in Volatility for Profit and Protection. Before we get started, everyone use the chat to let us know first that you can hear us, where you're from. I am from the Philadelphia metropolitan area, Bucks County, actually. Dima is from Philly, and Jay is out there in Arizona, though he comes by way of Chicago. He was a big trader on the CBOE, and also, did you trade on the Board of Trade, Jay, when you were out there, or just the CBOE?
Options exchange, yeah, CBOE. I mean, I was a member of the Board of Trade, but you could option that membership to trade on the CBOE, which is what I did. So
yeah, no, it was amazing, those memberships in those years. I mean, you look back at it, and it was incredible what you could get a membership for and the value they turned in to be. But before we get started, D, we'll just share the disclaimer. Does that work for you?
Yeah, let's just do that really quickly. And thank you, everybody, for joining us. Before we start, just keep in mind, Will and I, Jay, Investor Alley or Market Chameleon, we're not registered investment advisors or broker dealers. We're not telling you what to do or just sharing ideas. If you need professional help, contact your registered investment advisor or call your broker. Your broker should be able to help answer your questions or provide you with guidance. There's the disclaimer.
Awesome.
And yep.
So with that, Jay, let's get started with the webinar.
all right, I'm going to share my screen here so we can go right to the Chameleon. Let's see. All right, everyone see that okay?
Yeah, it looks good. Love that screen.
So let me say, and Will and Dmitry are not paying me to say this, that, I use Market Chameleon every day. And I, as being a former institutional guy, and I have a lot of friends in the institutional space, I mean, I can get a lot of the same stuff that they're getting, paying $3,000 a month with a Bloomberg terminal. I mean, yeah, we don't track institutional products in Market Chameleon, things like that. That obviously that's not what it's meant for. But in terms of, equity options, there's, it's amazing that the access that Market Chameleon gives you that, you really didn't have before. You'd have to spend ridiculous amounts on some of this institutional stuff. So I am very thankful, because I'm not sure I could actually do my job without it. So, and they're always adding new features too. So I noticed you guys added a forum on there recently.
We did, and it gets questions are asked. People are into it. Dmitry personally answers as many questions as he can get to. I think it's added, do you get to sleep at all at night, Dima?
I mean, yeah, I try to. It's like sometimes
intermittent. He is the king chameleon. Without him, this thing doesn't work. So thanks.
Thank you, Jay.
Yeah, of course.
Thank you, Jay. That was super nice.
So, my primary, as an ex-market maker, I try to look at volatility, when making trades. I mean, you don't necessarily need to be a volatility expert to make directional trades with options, although it certainly doesn't hurt. But, I try to look at trading volatility as my sort of the basis for what I like to do. And so there's several different ways to do that. But if you want to see what the process looks like, that's what I'm going to show you for kind of how I find trades. Now, your goals may be different. You may be looking to hedge. You may be looking to sell volatility. You may be looking to buy volatility. So your goals may be different. And, if we have time, then I can show you some different methods for doing that. But the analysis where you start from can be the same. And so I may start with something, just as basic as like a snapshot like this here, which breaks down the volatility in the different sectors in the S&P 500. And this is a good thing to look at. I look at this multiple times a week to kind of see where where the action is, so to speak. And you can see today that healthcare is increased and it's elevated. We had a down day today, so a lot of this stuff is higher than it was the last time I looked. But this IV percentage here, really anything over 70% of where it is on a yearly average, that gets into the elevated range. You can see that everything here is at least moderate, even utilities, close to around 50%. And that include, this is a year where there was a crash. So the average level is obviously a little bit higher, but you can see healthcare, you can see tech is elevated. So if you're looking for a trade, if you're looking for a volatility trade, this is a good place to start, because then you can go to that sector, or you could trade the sector. So, I mean, all these are very liquid instruments here. All these X ETFs are all very liquid. They all have very, very liquid options. So you could actually just trade volatility on the sector themselves. Another thing here is the major market ETFs, and I use this one a lot as well. Oops. Yeah, there we go. So you can see, I in terms of indexes, I focus on SPY, QQQ, which is NASDAQ 100, and then IWM here, which is small cap. So you could see also that QQQ is elevated, which makes sense because you saw that XLK, the technology sector, was elevated, and you would expect QQQ, which is very much tech heavy, to also be elevated. But I look at this for, let's say, gold. I'll trade gold quite a bit, emerging markets, China, IFA, bonds, so I'll look at this stuff to see where lately metals have been pretty elevated. We're down to about the 60% range for gold, but that's still pretty high. So this is a good place to start if you want to see where the action is. From there, then you can decide, all right, what do I want to do? Do I want to look at, maybe try to find a stock within one of these sectors? Do I want to trade the sectors themselves? For this webinar, I'm going to focus on trading the indexes, because generally, I mean, that's probably the most common way to trade volatility. I'll look at something like SPY or QQQ or IWM. Those are all heavily traded, all very active. You could use the indexes themselves. So SPX is the index equivalent of SPY, RUT, RUT is IWM, or NDX for QQQ. So you can trade the indexes themselves. They tend to be more expensive options because they're much higher price indexes. So I like to use the ETFs just because if you're working with a budget, you're going to have a much greater opportunity to find trades in the ETFs than the indexes. So
Hey Jay, can I interrupt you for a sec?
Sure, absolutely.
We got the first question in from Sam, and thanks for putting it in the chat, Sam. You can also put it in the Q&A, and we'll get to it. But this is relevant because Sam's asking a real quick question. When you talk higher IV, does that necessarily mean higher option prices? He really wants maybe a little more light on IV. Yeah,
absolutely, and that's actually a great lead-in, because I was just about to move into the conversation on IV. So let's do that. Let's actually go to SPY. It's elevated, so it's a good one to look at anyway. So SPY, of course, is the S&P 500 ETF. So, I look at this one. What we're about to look at, I look at, again, multiple times a week as a good proxy for what's going on in the market. Now, SPY, even though SPX may be a little bit more of an institutional instrument than SPY, institutions also use SPY. And in fact, SPY is probably more liquid across the various option strikes. And it's actually, in many ways, it's a better product even. So it's a great proxy for the market. So if you want to see, kind of get an idea what volatility looks like in the market, going to SPY is not a bad choice at all. So you don't necessarily have to go into VIX or go into SPX or something like that. So, all right. So the question was, with implied volatility. So what implied volatility is, it's really kind of the reverse answer to the Black-Scholes equation. And let me expand on that. So if we were to go, let me go to the options chain here real quick. So if we go to the options chain, and let's just look at like the options for, the end of this week, October 23rd. So if we wanted to see the at the money call here for the end of the week, the 342 call, the market is 343, 347. So let's just say 345 is our midpoint. So how is that calculated? Well, Everybody's got a little bit of a tweak on their model, but most of it is based around this Black-Scholes model, which is, it basically takes the various factors and it's kind of like a probabilistic sort of calculation of what chances are of something ending up in the money. So it takes things like strike price, underlying price, and dividend and interest rates. But the one thing that is kind of uncertain in that equation, the one thing that people have an opinion on, is volatility, right? So how volatile is this product going to be, usually measured by a standard deviation, right? So what happens though is that we have a market, right? We have this great existing market with tons of people trading, and we see what the prices are. So if we then put these prices back into Black-Scholes or some equation and reverse calculate it to find out what volatility is being used, that is our implied volatility. That is what the market thinks is going to happen over the next 30 days, right? It's some standard deviation of an annualized move in the S&P 500. So if it's really high, you think the S&P is going to move a lot. If it's low, you think it's going to move less, right? So by definition, higher implied volatility absolutely means higher option prices. Now, there are other factors, right? As you get closer to expiration, or, if you move in or out of the money, that'll obviously outweigh sometimes what happens with implied volatility. But if you were to hold everything else constant and just use a higher implied volatility, absolutely 100% it raises the option prices. So that's why it's so important, because it can be very significant. Right? We could, you'll find times where, the stock won't move. Let's say we open up at 342 again tomorrow, but people are worried about some news item coming out later in the day. This price might go up quite a bit, even if this doesn't move, or even if it goes down, right? Maybe it goes down to 342, and this price actually goes up to $4 because you have a several percentage point increase in implied volatility. So extremely important to understand that volatility can heavily impact prices. All right. So that being said, hopefully that answer your question. I know that's kind of long-winded, but I wanted to, that was my goal, was to kind of give a thorough definition of implied volatility. So I took the longer route to answer that question. But so this green line here, this is the implied volatility. And let's look at 3 years here. So, and the reason I want to look at 3 years is because we have this crash here, and it kind of, it kind of skews things, and that's fine. Certainly, obviously the crash is a big reason why implied volatility is continues to be elevated. Usually there is some elevation after a crash. Of course, the other reason, the crash was due to the pandemic. And so the after effects of the pandemic also give us higher volatility. But probably right now, the vast majority of the higher volatility is related to the upcoming election, right? It's a major unknown event coming up. So a lot of options action positioning ahead of that, a lot of hedging or potential bets on volatility ahead of the election. So, but anyways, so looking at the full 3 years, and you could see, this is a more normalized situation. And a non-crash year, you have a few spikes every now and then, usually related to economics news of some sort, or, and then obviously we have this, very large spike for the COVID crash, and we have elevated. So you can already see, just looking versus the past, that volatility is more elevated than it is. And so you already have a tool right here to trade. You can already say, you know what, I think that here, let's even go to 5 years here. I think that this level here, closer to, looks like a 15 level, seems to be the case where it hangs out for the longer period, right? And you're looking at it now, and it's 25. So you may already say, you know what, I want to take a long-term view that volatility is going to go down, maybe in a year or whatever it might be, right? So that is one way you can use volatility to trade. Just compare the implied volatility versus what it was. You can also another way to look at that is you can actually put the moving average, 20-day moving average of volatility up on the graph here. Let's zoom in a little bit for that. And you can see where it is compared to where it has been, right? So the key though with volatility is that it very much is it's very much a present weighted, it's a current situation weighted sort of metric, right? So even though we might say a long-term bet on volatility is that it's going to go down to 15, and I think that would be a reasonable 2 or 3 year goal, right? But you can't just say, you know what, it's 15. It was 15 in January, so by next January it's going to be down to 15. That's it, completely ignoring the reason why it's higher, right? Volatility does have a memory, and the memory is we had a crash, we have a pandemic, we have, and also a future, we have an election. So certainly we're not going to see this number drop down, at least until after the election, at the very least. Then we have a transition period, and then we have more pandemic stuff coming up. We're in the middle of earnings season. So we have lots of reasons. That is very important. And that's where looking at something like the 20-day moving average is useful. You can see, all right, well, the last 20 days have still been, all these factors have been known for the last 20 days. So how does this compare now? Well, right now, maybe it looks a little bit higher than it has for the last 20 days. But again, that may make logical sense. We have an election coming up in 2 weeks. So maybe we expect to see this go up a little bit. So all I'm saying is that these are all different tools for analysis, but you don't want to look at it blindly, right? You want to look at it and say, what's going on? Is there a reason for this? Now, if there's not a reason that you can come up with, or if the reason is something that you believe to be short-term, that might be a situation. That might be a situation where you say, all right, the election's coming up in 2 weeks. I think no matter what, volatility is going to go down, at least for the short term afterwards. All right, that's a reasonable thesis. So that might be a situation where you're like, okay, right before the election, I'm going to take a short position on volatility. And we'll talk about, again, how to do that coming up. But or another one, and one that I actually just made for some of my subscribers was, you know what, I think volatility is going to go up until the election. So we might see it kind of like earnings. We might see it start to sort of drift higher going into the election. And then immediately afterwards, I'll probably shift focus and say it's going to go down that week, right? So that's a thesis that you might have. And you can look at, and then you look at this, look at this information here and say, all right, well, is it drifting higher than it has been? So this is used to sort of, give proof of your point, right? Another thing you can look at is historical volatility. Right. So this is so the last one was just the moving average of actual implied volatility. Right. Now, keep in mind, implied volatility is always forward looking. Right. It's looking at the next 30 days. It's looking at what the market expects to happen. Now, the market's not always right, of course, right? The market, and also, there are transitional periods like after the election. Like no one exactly knows how the market is going to react after the election. So there is uncertainty there. Okay, so one thing that you can do though is you can compare implied volatility, which is forward looking, to historical volatility, which is backward looking. So in this case, the last 20 days. All right, and you might say, all right, well, how can you compare something that happened in the last 20 days with something that happens over the next 30 days? And the answer is because statistically speaking, the best prediction for next day's volatility is the day before, right? It's just like, a model for currencies, right? Or model for a lot of things. Like it's still a decent predictor. It's not perfect, right? But volatility has a short-term memory. It remembers what's been going on. And once again, like I said before, we don't look at historical volatility from January and say, wow, it was 9%, and now it's, now implied volatility is showing at 25%. You don't just look at that in a vacuum and say, oh, this needs to be lower. I'm shorting volatility. You have to look at why. All right. Once you look at why, then you can compare. All right. Now actual historical or realized volatility is about 20%. Implied volatility is here about 25%. These numbers are actually relatively close, given all the things going on right now, how the market is actually moving, and then what we're expecting to come forward. I don't think that that's a tradable gap there. I don't think that that's anything saying, all right, sorry, my internet just told me it's being unstable. So if I blank out a little bit, it should be
Yeah,
temporary.
I was just going to ask if that was me or if that was you, but it does sound like it may be your internet. You
Yeah,
good?
I could see it just blipping now, but I think it should be. Let me just double check. All right, yeah, it looks like my connection has solidified, but so there's not some sort of set gap where difference between implied volatility and historical volatility is necessarily tradable. That's where you want to look and see what it has done. All right, why would you compare implied volatility and historical volatility? Well, because there's a thing called the variance risk premium, which has been around since the beginning of time and will most likely continue to be around until the end of time, which is an edge in trading volatility that stays there and will pretty much always be there. But there are periods where it kind of goes away. So it's not, again, like value stocks, right? Statistically speaking, we know that over the long term, value stocks outperform other stocks, right? But if you had just bought value stocks this year, you'd probably be getting crushed. And value stocks are not performing well this year. Over 30 years, it'll probably be fine, right? Now, variance premium is not quite, you don't have to wait 30 years, but usually like, multiple times a year, your variance premium edge is going to pay off, right? And what that means is that implied volatility will be higher than historical volatility. And it'll be that way because people are using options to hedge their portfolios or something along those lines. They have a mandate. They want to protect their portfolios. They're willing to pay up for those options. And that'll cause this difference in implied volatility to what has actually happened, to what actual historical volatility is saying maybe it should be. Now, a lot of times you can trade that, but the problem is that you don't necessarily want to trade it when there's event risk coming up, like an election, right? Because then there's a reason why people are hedging. They're hedging because what happens if there's a contested election and people take to the streets and and there's fires and everything, that's a volatile situation that could happen, hopefully not, but it could. And so people are hedging their portfolios, and there's a reason why this number is higher. Now, if you look at other periods, so, let's say you look back here, just, randomly, just picking a period where it's higher, you can see this December of last year, before we had any of these issues, implied volatility was higher than historical, maybe suggest the year off for Christmas or whatever. And you could see that would have paid off. You would have, if you would have had a short implied volatility position, whatever it may be. And again, we'll talk about some different ways to do that. But if you had a short volatility position, that probably would have paid off. And in most cases, it will pay off. But when you get to a situation like here, this was an interesting situation. The market stopped moving in August, probably because people were taking vacations, as much as they could due to the pandemic. But in August, from anecdotally, a lot of people I knew were finally like, you know what, we're going to go on a road trip. This may be our last chance to do something before the fall starts. So you had the market basically come to a halt, but people were still worried about the pandemic and the election and everything else. So implied volatility stayed elevated. The market didn't actually move all that much. And then, all right, so we have a backdrop. We have different ways to analyze. You can look at multiple year historical volatility, implied volatility, moving average. You can compare, and if you don't want to just look at, let me move my video screen here. All right, well, how did the SPY look compared to the QQQ? And you can see that QQQ, for the most part, has quite a bit more volatility, but has roughly moved the same situation. This might be a thesis that you want to follow. You might say, all right, well, QQQ is driven by 50% of its valuation is from the same 5 stocks, the Microsoft, Amazon, of the world. SPY is driven about 25% by those same 5 stocks. So you might look at those 5 stocks and say, you know what, I think their volatility is going down, and that's going to impact QQQ more than it'll impact SPY. So maybe I want to take a short volatility position in QQQ. That's an example. That's not actually a thesis that I have. I'm just throwing out an example. But you can see that obviously the volatility moves roughly the same way as SPY, but it's considerably higher in QQQ. So that might be another opportunity, or IWM is another one that I look at regularly. And you would expect small cap to have more volatility than SPY. If this gets really close, you might say, you know what, I need to be buying volatility in IWM because, small caps are a lot, riskier in a high volatility environment. And the fact that they've gotten really close means I need to buy volatility. And that might have paid off here. As you can see, it's remained elevated over SPY. So different ways. So, what I'm getting at is that there are a lot of different ways you can trade volatility. So now the question becomes, what can you actually do to trade this stuff? And that, I think, is kind of the, I think that's the trickier part. Before I get into that, I don't know, Dmitry, do you have anything to add before I get off this page?
No, I mean, I think it's pretty good unless somebody had a question. I think there was one question.
We did have a question out there. Sam asked, he was the one who asked about the higher IV. He then went on to ask about spreads. He said, so for put spreads, credit's high IV is beneficial. Do you guys have an idea how to answer that? I know, Dima, what were you saying about spreads?
Yeah. So when you're trading a spread, keep in mind that you're buying and selling an option. So you're doing at the same time, you're actually buying Vega and selling Vega, and you're hedging some of that implied volatility off. So you're not really, taking in a implied volatility bet. And at that point, when you have a spread, it becomes very tricky, because if the stock moves closer to your short strike, you're actually short gamma, short Vega. If it moves closer to your long strike, you're the opposite. You're long gamma, long Vega. So it's not so much as, it's trickier because you're buying and selling an option. So you're buying implied volatility and selling implied volatility at the same time. And then it's kind of path dependent where that stock goes and what the implied volatility does as it's closer to, your strike, the short or the long, and that's like a lot of times why you see risk reversals skewed, because the risk reversal is kind of spread itself, right? You're buying one option, you're selling another option, you're hedging off. It gets closer to your short strike, you're going to be short implied volatility because your Vega to that short strike is going to be bigger. If it gets closer to your long strike, you're going to be long implied volatility because your Vega is going to be bigger as the stock is closer to that strike. So you can't really use the IV rank for. That's not really where you could use the IV rank.
Well, I think that really gets at what I was saying is that I think identifying trades with volatility is not the hard part. I think finding the appropriate way to execute them is where it becomes difficult because, for instance, I mean, if your goal is, if you see volatility going up and you want to hedge, well, with an index, all right, well, that's easy because it's a directional play. You're hedging your downside risk. So whether, depending on how much you want to spend, whether you use a put or a put spread or whatever, you're just using that volatility as an indicator that you want to hedge. You have a directional opinion on that because you're protecting. That's a little bit easier. Now, the question is, though, if you're just trying to trade volatility and you don't have there's not a directional play in mind, that's where it becomes tricky. So, and I think that, actually, let me go to this page. I think, so the funny thing is that it's relatively easy to buy volatility, although it can be expensive, just using something like a straddle or a strangle, right? So, a straddle would look like this, strangle. So the only difference is strangle, you're buying an out of the money call and an out of the money put straddle, you're buying, typically it's the at the money. You're buying the at the money, both call and put. So you make money if it goes in either direction. That is basically the definition of volatility, right? If it moves a lot in either direction, it can be volatile. The problem with strangles and straddles both is they can be expensive. So, however, relatively easy to put on. If you think that, SPY, let's look at an actual. So if you think that because of the election, S&P 500 is going to move all over the place. We don't know what direction. We just think it's going to move. We can go down to, let's say, November 6th, so the Friday of election week, and say, you know what, I'm going to buy that at the money straddle. Now, I can tell you right away, it's going to be expensive. So first of all, volatility is high. Secondly, this is a higher priced stock, so the options are going to be worth more. And sure enough, it costs, over $16 to buy the 342 call and put. So you would need it to move. You would need it to move $16 in either direction to break even. I mean, this is assuming you're not delta hedging and you're not gamma scalping, and I'm just talking about straight up buying the straddle and letting it go. Now, I mean, if you think about it though, 16, it's not actually a huge, it's what, 5%, it's around 5% move. If you think about a 5% move in an event coming up that is in many ways monumental, right? As this election, 5% is not necessarily a huge number, but it's definitely a big number. So $16, that's $1,600 for one straddle. All right. Well, you say, all right, well, you know what? I don't want to spend that much. Maybe I'll buy a strangle instead. So I'll just go down $5 on each side. So let's say you buy the 337 put and the 347 call here. Oops. There it is. So now you're going to spend considerably less, but you need it to move further, right?
I think you did a buy and a sell.
Oh, yeah. Yes. Thank you.
Yep.
There we go. All right. So here's the strangle. So now you have to go, from where we are now at 342, you have to go down to 325. So it's around the same, it's not it was $16 on the straddle. And now we have 342. The break even is around 325. So that's $18. So it's not that much different. And you're spending, in this case, about $4 less. So this isn't much of a change here. So now you have to look and say, right, I'm saving $4. It needs to go about $1 more. Probably, to me, that's probably not worth it unless I'm going to spend like half as much. Then you might go and you look at a different strangle that's about $8, and then you're going to find it needs to move $30. So you look at this, and of course, when it's expensive, it's a little harder to do. But that is a straightforward way to trade volatility. Of course, you can use spreads. You can turn these into spreads and stuff like that to save money. There are different things you can do. I'm not going to. There's a billion things you can do. I'm just talking about some of the more basic strategies.
Since you're on this strategy, D, maybe you can help Satish just ask, is there any way to see what that has done historically, that trade from this, like what the win rate is or anything from here? He's asking if he can see that, D, from what Jay has up right now. Can he go and see the historical win rate of this trade or anything like that?
So what you can do is run, there are different ways to look at it. I think I saw he was asking for a back test, but
right.
So there's different ways of looking at how the options are priced, or the win rate, like you're saying, or what it's worth. And one way is to apply just a volatility, historical volatility, or a return distribution, or what people as a back test. A back test is something different. Is like when you're like, a back test is like when you have a strategy, right? And you're doing something, saying, this is what I'm doing at this moment, at this time, and you're back testing against some out of sample test. So in the distribution where you see the theoreticals, what it does is actually go back and say, based on the historical return distributions. So yeah, if you keep it up there for a second, based on how the stock actually moved, this is how, because the options are priced at what they would be at expiration. So this is basically how based on how the stock moved in the same period as to this expiration. And if you did the same trade, with the same distance away from the spot price, and you did the same trade with the same amount of premium percentage wise, that the end result historically in the last 4 years, this would have been $5.87. That's where at expiration, that's the average price, $5.87. Today, you're at $12 a bit, right? So much higher than the average end value. Historically, what this is telling us is 14% of the time, the stock moved enough to make, if you bought it for $12.14, like in this case, 14.3% of the time, it moved enough to make it profitable, right? The rest of them would have been unprofitable. So that's how, hopefully that helps answer the question, but that's where you're applying historical return distributions to the options. And usually as professionals, we use option pricing models, right? Not so much back testing, because back testing is trying to kind of test, it tests your trading style almost, right?
Right.
In a theoretical, like when you hear what do options traders use, Black-Scholes, binomial, these are actual pricing models, which kind of do the same thing, same trick to tell you how far away are these options priced based on how this stock moves. So right there, you have the win rate and the theoretical price. That's a theoretical value, what it would be worth at the end of expiration.
And
Very
I think
cool, D. That was super helpful.
Yeah.
Hey, listen, we just had a couple people join, and someone asked about replay of this webinar. I'm sure Jay and Investor Alley will send it out to everyone who is registered. Dmitry and I will also put it out on our YouTube channel. Jay, I don't know if you know, but Dmitry and I do a morning show every morning at 9 a.m. Right, D? Every morning during the trading day. Every day that the market's live. So I just put that link. Make sure you register for our YouTube channel and you get alerted to when we go live. So, and we will put this on the YouTube channel if you arrive late.
Yeah, and we will definitely send it out. Investors Alley will definitely send out the replay.
Perfect.
Usually it takes about a day to send it out. So
awesome.
But I think this is a good, that was a timely question, because you can see how much volatility is elevated now. If you look at, what the, look at how much higher the current bid ask is than the theoretical value. That is because of concern. That's because of volatility, right? It's concern over the election and pandemic and everything like that. I mean, I would bet that this number we'll probably see volatility fade after the election, but that doesn't mean you don't want to. There's a reason this bid up here, right? Yes, it's likely that volatility will go down after the election, but it's bid up because of the possibility of a contested election and how people react to that, and there could be very volatile events around. So it's not a situation where, to use the phrase, you don't want to be caught with your pants down, right? This is not a situation where I'm ready to short volatility. I'm going to be very careful. Immediately after the election, I'd be willing to short volatility after we see some, like, the next day results, right? You'll have time to get short volatility, but if it moves against you and you're short volatility going into the election, I don't recommend that. Even though, again, it's very likely volatility is going to drop down. If something happens, you don't want to be the one that has your pants down, even when the market's clearly telling you they're worried about what's coming up, right? So, so this is we've been talking about straddle, strangle, just betting on pure volatility. Now, if you want to hedge, of course, you're just taking it. That's a lot easier, right? You're just taking a directional. You're just making a directional trade, and it could be something as simple as buying the at the money put. Right. or, as we were talking about earlier, maybe doing like a vertical spread, right? So an interesting thing that I've seen that some professionals, some funds do this, is that they will change, if they have a directional trade like this, they will change it based on volatility conditions. So if volatility is really low, then they might just buy the put outright, right? They, forget, where's the remove button on this? There it is. Just so, this is your straight put if volatility is low. All right. If volatility is a bit higher, all right, so then maybe they add that, let me do something. Let's see, $10 lower here. All right. So then you have a put spread. This would be a slightly, a higher volatility conditions. If volatility is really high and even the spread is expensive, then they may consider, and this is going to be somewhat somewhat dependent on the environment, but they might consider actually turning this into a butterfly. And so then we'd add a 322 here to make it even. And then it would look now. So then you have a range. So you're paying even less. So you're only paying compared to 380 or whatever it was, you're paying $1.22. Now I wouldn't recommend a butterfly, even though volatility is really high. I wouldn't recommend a butterfly going into the election just because we're talking about serious event risk. I would say something a little bit more, maybe like a Fed meeting or non-farm payrolls or a normal volatility event, not a once in a lifetime volatility event, which this election could be. So that's a situation where you need to read your hand, you need to read the table before making the decision. But I like, for hedging, I like doing this quite a bit because I like to hedge. I think that's something that a lot of traders don't do. Most people are long, they're long the stock market, they're long trades. They like to make money when things go up. And so it's pretty easy to find cheaper hedges, maybe not right now, but generally speaking, you can find hedges, just by doing some kind of spreads on SPY or QQQ or something like that. And you could use this model where if it's really low volatility, like 2017, you're just straight up buying puts or out of the money puts. And if it's it's more like normal, then you use a spread. And if it's really high, you use a butterfly outside of, again, this election period where I'd probably stick to a spread rather than a butterfly. But I like the choose between the naked option, the spread, or the butterfly as your directional trade. That's something that I like to do. I'm a big fan of butterflies as well. All right, so that leads me to the last thing here, and then we can take questions, is how do you sell volatility? Because we've been talking about buying volatility and hedging, which is also, in this case, buying downside volatility for the most part. So what do you do, in most cases, and if we're going back to that variance risk premium, most of the opportunity is on the selling volatility side. And that honestly is the problem, because it's not easy for the average person to sell volatility. You can't sell straddles or strangles in most accounts. You have to have the highest level. You have to have a decent chunk in margin. So you get to the situation where it's not super easy to sell volatility as your retail trader. Now you can for the market, because there are ETFs and ETPs like VXX, which is short-term volatility based on VIX futures, and you can just buy a put, or you can buy there's only a half inverse right now, but there's going to be a full inverse of VXX probably released by the end of the year. So for the S&P 500, you can trade the ETPs, or you can trade VIX options, which is market volatility. Now, if we're talking about individual stocks, then it becomes harder, right? Because most likely you're not going to short, you're not going to short straddles or strangles. You might be able to use like calendars or double calendars or something like that. One thing you can do is use a butterfly or a condor. It's not exactly the same, but it's probably the easiest way to do it. So for instance, if you think that volatility is going to die after the election, and again, I wouldn't make this trade before the election, but just for an example, let's stay with that November 6th here. So in this case, maybe you don't want to sell a strangle because you have unlimited risk, but you could sell, let's say Let's just do like a 5 wide condor here. And so I use 322. So let's go up to 362, just trying to make it even distance. You can use delta or whatever. It doesn't have to be exactly the way I'm doing it. Sell and then buy. So, all right. So here, this is what a condor would look like. So if you stay in this range, if you think volatility is going to go down, then likely you'll be range bound. And then you'll make whatever, $1.20 from this. And then your risk is only about 400. So this is condor is not exactly, it's a range bound trade. So in essence, it is a volatility trade. It's not as pure of a volatility trade because you're dealing with skew also and some other factors, but it's an easy way to do a somewhat short volatility trade without having a lot of risk, and something that your broker will allow you to do if you have a basic margin account. Right. So, I used to use condors all the time. I haven't, it's not my favorite trade right now. Maybe after the election might be something. You can use butterflies. So it's just narrows it quite a bit. I probably wouldn't use a butterfly with an index. That might be good with a single stock. If it's not a super volatile instrument, but butterflies are basically the same thing, but they're narrow. They come to a point here. So those are some ways to short volatility. Again, it's much easier for the market because you can just use those exchange traded notes, or you could use the VXXs of the world, and you just buy straight puts on those, or you can sell calls on them, or whatever you want to do. You could use those to trade market volatility. With individual stocks and other indexes that don't have a VIX associated with them, then you have to kind of figure out how you want to do it through options. So I covered a whole lot here, so I figure we'll leave plenty of time for questions, because we covered a whole lot of ground, and every one of these could probably be a separate webinar, right? We could do a separate webinar just on trading iron condors, right? So, but yeah,
it's going to be super interesting looking at this, 6 months after this election, because
absolutely,
the way they're pricing this election, something interesting could happen. We do have a question about the election vol from Satish. He's asking, high volatility in November and December is understandable, but why is it so high in January and February? Can this be used to our advantage? Maybe using a butterfly strategy in Jan Feb. How about a butterfly strategy in VIX puts?
Yeah, I think so. And I know some people have been talking about doing the butterfly with futures, which is a little bit different, where you're using the futures months, and maybe you're short February and you're long January and you're long March or something like that. But I think that the answer is I think that, certainly some of it is mechanical. With November so high, you're not gonna, the curve is gonna somewhat rise kind of across the board. But there are some other things here. There's obviously, November, December, obviously you have transition periods. Some of that may roll into January. I personally think this has a lot to do with the pandemic, because we're talking about flu season, a good time for, a second/third wave, whatever it is, to rear its head. But, some of it, certainly, would I be shocked to see the whole curve move down after the election? No, not at all. But the market is pricing that there, and it's not a mistake. So, you want to think about it and say, do I really want to bet the farm on it? Probably not, right? It's priced that way for a reason. I would probably lean short at the beginning of next year, but I would do it in a careful manner, because it could be about the economy, and about, maybe once the focus of the election is over, people are going to realize how much damage is occurring again because of the pandemic. And if it spikes again in the winter, like people are predicting, then it could be really bad. So there could be some other stuff at play. Butterflies might be a good structure for that, for sure, because it's, relatively safe.
Great. I have 2 questions for D. The first one, D, is coming from someone who uses the Chameleon, but he's from Canada. He's asking, is there any chance the chameleon ever comes to Canada with Canadian options. I would say we'd have to get a lot of requests, but that's my feeling. But I figured you should answer that.
Yeah, right now if there's Canadian stocks that are listed on the U.S., then we're covering them. But Canada in specific right now, no, because every exchange is different. You have to get the feed from the exchange. You got to license it, and you have to have enough demand. And it's costly. Not only that, the problem is that they're different. So it's not like a plug and play thing. You'd have to have enough. We'd have to have enough. We do get a lot of people though I have to say from Canada that trade U.S. equities from Canada. I think like isn't TD Ameritrade, that's Canadian, isn't TD
Yes,
Bank?
it is.
But so we do get a lot of people, but just going directly right now to like the Canadian markets, we're not doing that right now, and we don't have any plans to do it anytime like soon. So I'd say like right now it's not in the plans. We'll probably maybe before that we would probably start picking up fees like kind of to Jay's point, start coming for the indexes which have much more liquidity and trading in there, like the SPX, RUT, like those.
I like to see VIX. If you ever pick up VIX, I would love to see that.
Yeah, unfortunately, all of these are different feeds, different licenses,
and they're expensive.
They're very expensive, and just to process it, because when you go to the exchanges and like you guys see prices and bids and offers and everything, but you go to the exchanges and they're just giving you zeros and ones. So somebody has to program, and what you're seeing, that's all a program processing those feeds, zeros and ones, to make it look like this. So that's why it's not like it's like, sometimes people are like, oh, just turn it on, but we can't do that.
All right. So the second question, D, could you find a good trade idea using the chameleon in SPY if you were bearish right now? I don't know if you can share your screen and show us how you'd walk someone through that.
I mean, yeah, like here, I could just share my screen real quick.
Yeah.
How do I share my? Can I share my screen, Jay? Is that all right? Huh?
Yep.
Yeah, that's fine. Yeah,
you share your screen. Well, he's getting that up, Jay. We had a question from Satish. He's asking you, what's better to trade, the VIX or the VXX?
It really depends on your goals. I like trading VXX because I've been trading it for a long time and I have a good understanding of how it works. But certainly nothing wrong. You're getting a little bit more granular when you're trading VIX because you're trading it to the individual month, where the VXX is always a combination of the first two futures months. With the VIX, you're trading this individual month. There's not one that's better than the other. It's really just what you're more comfortable trading.
Cool. Awesome. All right. So D, let the chameleons know how you actually got to this page.
Yeah. So I just went to SPY, and right here, when I go to the trade ideas, what this does is it's picking up things that from our screeners that we have preset filters. And once it hits our conditions, like, it's looking for a certain amount of theoretical edge, it's looking for a certain historical win rate, and a bunch of other stuff that we have in there. And once it hits it, it creates a trade idea opportunity card. So here I just went, now you could do like a bear call spread, bear put spread, and we're actually adding just like straight, buying puts. I don't know if you saw that, Jay, but we're going to be adding that. That's in the screeners right now, long puts. And we're going to be adding trade opportunity cards for that as well. But here, like, as you can see here, it just filtered out for bear call spreads. So just to give you an example, this first one, it's looking at the November 18th, selling the 358 call, buying the 362 call for 89 cents. We think it's worth theoretically 42 cents, which gives you a 15.3% theoretical edge with a historical win rate of 88%. So that's really quickly, it's filtering out different ideas for you using a statistical analysis to get you that, a little bit of a statistical edge based on, where where the historical data, based on the historical data.
Very, very cool. D, real quick, while you're on your personal chameleon, someone's asking, how do they quickly find a list of stocks that the IV right now is high relative to some sort of historical volatility?
Sure. So under here, where that you see where I'm on the options here, the main
Yep.
menu. On the options here, you see implied vol rankings.
Uh-huh.
So click on that, and you have all these filters here. IV up, IV down, IV elevated. So here you have two types of IV, right? One, this one, and is the IV percentile rank. So what the IV percentile rank is, it's taking in the last 252 days, right? Every day we save an implied volatility snapshot for a 30-day constant maturity. We take an implied volatility snapshot, and then what this is saying is, well, today's volatility over here is 142. So 89% of the observations in the last year were below today's value. This is what the IV rank is, okay? 89% this one, 97% of the observations in the last 252 days were below this 196.2. So that's IV percentile rank. Percentile rank, just like if you used your Excel spreadsheet, typed in your function, percentile rank, same idea there. Here, this is IV position rank. And what this does is say, well, just give me 2 points, the high and low of the lowest point out of the last 52 weeks and the highest point, and tell me where percentage-wise it is positioned next to the 52-week high low. So this 105 means that it's already 5% above the 52-week high today. So you see, like, way above. This is saying that it's 70% between the low and the high. So you have those two to kind of give you guidance how far it is from the very high to the very low, and relative to the last 252-day observations.
Very cool, D. Jay, we had quite a few people who were very pumped about you coming on and joining the Chameleons. And we've had Jay on quite a few times. There are a lot of good videos out there. I mean, he goes all the way back to when my brother was in this seat and did some great interviews with my brother who was in Costa Rica. But Jay's a good friend of the Chameleons, and we love having Jay on. Could you just give him a little bit of your background again, Jay, and maybe what you're doing now? Let them know so they can follow you. Whatever you want to give them. We had 2 people ask about you personally. So
Sure. Yeah, so I was a market maker in equity options on CBOE. Actually, I started at the Kansas City Board of Trade, working for the exchange. That was my first job out of college, and I went up to Chicago and got on the CBOE and traded options, SPX pit, and then Amazon, WorldCom, AIG, Global Marine. I was a market maker in that pit for a while until the tech, sort of the .com bust, and then I moved to the software side of market making. Came down to Arizona to get my my MBA, and I stayed down here and got into the newsletter, sort of something I could do related to options while remaining in Arizona. This was before remote work was really a possible thing. So I got into, so I've been doing this research, newsletters, educational stuff now for about 10 years. And we do, we have begun. So I have like a beginner, like directional option trading service. It's more of just to get your feet wet. As you know, directional trading is not the easiest way to trade options, but it's probably the best way to get started without risking a lot of capital. So that's optionsfloortrader.com. If you're interested, optionsfloortrader.com is that. It's a $49 a year service. And then, then I have advanced up from there. We have, covered calls, and we do butterflies, and we do we do a few different things. I like to focus on education more than trading, because I just think that everyone's got a different trading style, and you find things that work for you, and that's the best way to make money. So like today, I like to do stuff like we did today. Talk about volatility and different ways to trade it and different ways to search, and then you figure out what works for you. Some people like Condor, some people like straddle, some people like covered calls, and that's where Market Chameleon is great, because they have all the tools for you to use to find really whatever you want. So I rely on it for just about all my trading decisions. So that's I've been in the industry for a long time, and you're not going to find better. So I think the first step is signing up for Market Chameleon, and then you can come check out my stuff.
Yeah, very cool.
Thank
I
you,
put
Jay.
a link out there. Jay has a checklist of must-haves. You can follow that link, and I'm sure you'll get a lot of information for Jay. Hey, Jay, great show. Thanks for joining us. As always, a wealth of information. Dima, awesome. Listen, everyone, we have a morning show every morning that is a trading day. Jay, you're always more than welcome to come home. Come on. I know that would be probably 6 a.m. for you, 7 a.m. Right?
That means I have to get out of bed, huh? Yeah.
You would need like 6 cups of coffee to join us then. But D and I do it every morning, and we love, and like Jay was saying, everyone's got a different idea. We've got probably 100 people now who are on regularly giving us their ideas. So D and I learn from them every day. They learn from us. So it's hey, give it a shot and join us tomorrow morning on at 9 a.m. And I put a link to that channel. So great job, everyone. Thanks, D. Thanks, Jay.
Awesome. Thanks, everyone. Have a good night.
All right.
Thanks,
Have
everyone.
a great day tomorrow. Stay safe, everyone. Bye.
Bye.